Hello, everyone, and welcome to our webinar today. Please just allow us for a couple of more, half a minute or more, just to give a chance to all attendees to sign in so we can start our webinar today. Okay, then. Good afternoon, everyone. I'm Adonis Pigasiou, and I will be the host of today's webinar, hosted by IGCA, the International Governance and Compliance Association. We have three distinguished panelists with us today. I will get to that in a minute, but first, let me say a couple of words about IGCA, the International Governance and Compliance Association, where it's a fast-growing global community of GRCC professionals, where GRCC stands for Governance, Risk, Compliance, and Cybersecurity. It's a professional association. We have members from all around the world. As I can see also from our attendees, we have a lot of them joining us today. The aim, we offer our own qualifications, the IGCA qualifications, and the aim is to allow for knowledge exchange between our members, to provide a professional networking and idea incubation. So we invite you all to visit our website and join us. There is a lot to gain out of this. Also, we have recently published our new online magazine, the IGCA Digest, which covers a wide range of very topical issues relating to governance, risk, and compliance. So that's about IGCA. Now let me go to today's webinar. And the aim of today's webinar is to analyze the future of both the risk and compliance function, and whether or not we should actually look out for a full-blown revolution or an evolution, given ongoing challenges that these sectors face. Together, with us, we have three distinguished and outstanding experts in the fields of governance, risk, and compliance, with remarkable both academic and professional qualifications. So we have a lot to gain from their input. Their contribution is without a doubt going to bring added value to this topical discussion that will take place today. And so without further delay, and without me going on and talking for more than I should have, I will first allow the panelists, our speakers, to introduce themselves. I will start off with the lady of our group, Samantha. If you can all say just a few words about your background and your area of expertise, that would be great for the attendees as well, to get an idea of where you come from. Samantha, let me just unmute you. Because you're on mute.
I'm set. Thank you, Adonis. That's wonderful. And thank you again for inviting me to take part. My name is Sam Sheen. I'm a subject matter expert in the area of financial crime prevention. I'm a solicitor and barrister by training, and I hold a master's degree in risk management. And my focus is on financial crime compliance programs. I have worked as a regulator, standing up a regulatory compliance function supervisory group, as well as taking part in a number of enforcement actions against firms offshore for failures to comply with anti-money laundering regulations. I've also worked in the private sector, and I'm also qualified as one of Moneyval's regional assessors.
Great. Now we have also Dr. Peter Wilson. Peter, if you can say a few words about your background as well.
Yes, thank you very much, Adonis. I'm an international tax advisor, and I've been practicing as an international tax advisor for in excess of 40 years. I've worked in many countries, and I've been based in the US, in the UK, Australia now, and Dubai. And my expertise is relevant to this particular group and this particular webinar is the compliance function that is becoming more and more important under automatic exchange of information, CRS, DAC 6, UK Financial Crimes Assistance Act, and what have you. As well as being a doctorate in tax, I have an undergraduate degree and 2 master's degrees, and also a chartered accountant in Australia and the UK.
As you can see, it was, justifiably very, I was justified to say that we have professionals with outstanding academic and professional background. So Socrates, your turn now, if you can briefly introduce yourself.
Anthony, thank you very much. I'm a risk management professional with roughly 25 years of experience in the financial services. I'm the ex-chairman of the Institute of Risk Management based here in the UK. Similar institution providing risk qualifications and training. So I'm qualified there. My day job is head of risk oversight for a reinsurance company, Reinsurance Group America, and we have operations across 13 countries in Europe, Middle East, and Africa. So I guess authoritative here to speak, and looking forward to engaging with my colleagues.
Great. Now, before I start, thank you very much, Socrates. Before I start with the first round of questions, let me also inform the attendees that they can place their questions either in the chat box or in the Q&As, so that I will have a chance to have a look at them and also ask the participants on issues that they want to raise. Now, before we go on and see the questions of the attendees, let me start with the first round of questions. I will first look, the thing that troubles us most over the past year is undoubtedly the pandemic. And I would like to ask Socrates, how do you think that, and whether do you think COVID-19 will forever change risk management in the financial services sector?
So thank you very much, Adoni. Very topical, and obviously a year on now, so a bit of a post-mortem conversation to have. I think a few highlights. COVID has actually tested the strength of the relationships in all the functions in a financial services organization, all the way from the board to the chief risk officer, the compliance functions, the executive teams, all the way down to the first line staff. It's a good news story, mostly. Risk management has continued to be a consistent and critical friend, and stepped up during the sort of, I guess, March 2020, when all this kicked off last year here in the UK at least, and showing that collaboration. So we all left our offices, the desks, and started working from home, and most of us are still doing exactly the same thing. But I think what has changed and what is the success story is that direct and open line of communication. So as you know, risk management is the second line oversight function, working with the first line, being that collaborative critical friend and stepping up and figuring out what are those critical risks that people were facing, as well as, you know, the remoteness from working from home. Good news is we were prepared. We have business continuity plans in place, disaster recovery. We've trained for this, but we never trained for it lasting for 12 months ongoing. So it's a good success story. And I guess through our conversations and the next questions, you know, what does the future hold? What does the future look like, and what have we learned? You know, in this crazy pandemic. I used to travel to 13 countries in 2019 and prior years. In 2021, I'm traveling to all my European countries without leaving my desk. So that's one opportunity. So I'll sort of stop there and allow others to chip in.
Sam, do you want also to add the perspective of the compliance function in during this pandemic? Sam, yep.
Sorry,
Great.
I think it's really opened the eyes of compliance functions about the importance of their data. And what I mean by that is when you can't just walk down the hall to go speak to another team, your next best place is the data that you hold as a business to make sure things are compliant the way they're supposed to be. You're able to detect failures in your control environments. and also that you're able to communicate effectively if you can't physically get together. So it was quite interesting. Initially, people were concerned the compliance functions would struggle to operate. And actually, the feedback I've received from a number of people is they're far more efficient as compliance working from home. They're not commuting, they don't have the extra travel time, and even moving from meeting to meeting or being interrupted all day, it really consumes a lot of time. But that having been said, things are going to go back to a different normal. And what people have found is that when you can't find people face to face, as is the current situation, how can you then go find the data or find other means to make sure the compliance is happening as it should? And I think as well, it's been a bit of an eye opener for our fintech friends in financial crime. So, of course, they are driven by a very different imperative, the customer experience, onboarding very, very quickly. And I think in some respects, this was a real eye opener for them. So it was less the look how enabled we were for the virus. When the virus happened, we all work at home. It was more look at the volumes of fraudsters who were able to punch through their front doors, who they had to exit quickly because they offer this fast onboarding and they hadn't anticipated how the pandemic would really increase the amount of fraud. So it has been a very varied experience depending on the kind of business you work in. But I do think for a lot of people, out of sight, out of mind did create some concerns about whether or not the controls are still working for compliance.
Yes, thank you so much. We'll get back to the technology question and the role of technology in a couple of minutes. But I would also have like the input of our tax specialist, well, from a compliance perspective as well.
Yeah, sure. There are a number of areas that have been hit by the pandemic, and I just want to focus on a couple. One is the economic substance regulations that have been in operation now probably since the beginning of 2019 in a lot of the former British colonies and other countries that have come in at the insistence of the European Union as part of their European Union's attempt to stop mobile money. In order to satisfy the economic substance requirements, you had to actually have people in places doing defined roles of a sufficient quality and having board meetings taking place in the jurisdiction, and you're supposed to have people actually sitting in those board meetings. Well, of course, all this has become very difficult if people who are international executives are not able to actually travel to the country where they're supposed to have board meetings. So the regulators have become much more flexible, and they've realised that you can't penalise companies because of the inability for those people to actually travel where they're contracted to travel. So that's an interesting development, and it'll be. I think we all keenly watch to see when people are able to freely travel, whether this so-called leniency continues. Another one that's particularly interesting is, it's a very boring example, but if for example, in the UK, if you're buying stock in a company, a private company or a non-publicly listed company, you've got to go through the scenario of sending a document to the government stamp duty office, get a nice official stamp put on it, pay the amount of stamp duty before you can be entered as a shareholder in the register. Well, of course, the stamp duty office doesn't function that way anymore. There's nobody there, very few people there to receive paperwork. So they now say that they accept applications for filing online. Well, over the last year, I must have filed about 10 of these applications, and they seem to be far speedier. When the regulator has questions, rather than waiting for letters to come through a post, you get the questions very quickly, you can answer them very quickly, and if there's an interpretation gap, either with you or the regulator, that can be resolved very quickly. So I actually think that the pandemic has driven inefficiencies out of the system and is enabling people and businesses to actually accomplish what they want to accomplish a bit quicker, and the regulators are becoming a bit less stiff about people having to strictly follow the processes.
Yes, thank you, Peter. Staying with the compliance for a bit now, the compliance function, then we'll go to the risk as well. Do you think that, I mean, COVID and the pandemic can be seen as a driving force for some sort of technological revolution, a shift to IT more than we were used to? And what's the role played by technology nowadays for the compliance function? Sam, if you want to have, and then we'll go to Peter before we go back to Socrates.
Oh, Adonis, when this started last year, everyone was expecting huge sales in technology and people were, going to jump on certain solutions. And some businesses did. Some businesses very, very quickly adopted technology, but they were already down the path of deciding they were going to go that route. So what they accelerated was more the procurement processes and the implementation processes. And often they scaled down the technology for a specific solution. So rather than fix everything along the onboarding process, they may have picked a particular activity or a particular line of business. Where we've seen realization something has to change is in the larger institutions who have struggled greatly in terms of getting the speed they need to change their transaction monitoring rules faster, harnessing that artificial intelligence to look for patterns of behavior. But conversely, there are medium and smaller size businesses just coming into AML who are getting a lot of traction in their arguments around, well, now we're building our program. Let's start with the technology rather than do it all manually. And interestingly, they're doing well. But the one group I've been really surprised by who struggled with the technology are crypto firms. So as you know, they all have to be licensed and they are our ultimate technology enabled group. You still find over the last 12 months, they really struggled with certain financial crime controls and they're still doing them manually. And I find this incredibly curious. As part of the reasons is they rely on in-house engineers and stuff, but it seems a bizarre thing, don't you think?
I would agree with that, definitely. How about the regulator? How did the regulator use technology?
Well, I think regulators have been using supervisory tech for some time. I think, though, they are much more savvy about the questions they ask of firms. So I think you will find now over the last 12 months with visits and examinations, those who did them remotely, they now know what to ask about the technology. But I think they in turn are looking to see what they have on offer for themselves. I think there's a real risk unless they speed up. The pandemic has taught them. They're a little bit far behind.
Still lagging a bit. Peter, close with to wrap up the compliance function and technology before we go on to Socrates.
Well, I think a lot of countries have been moving in over the last 10 or 15 years to filing tax returns online. The days of doing paper tax returns are probably 15, 20 years ago. But what we have seen is a speeding up and more efficient and more effective means of filing all this stuff and this stuff being analysed and questions coming back much quicker. Another area is the amazing software system that goes with the automatic exchange of information, whereby there's basically one model of software, and 150 or 160 countries in the world that have signed up to automatic exchange of information. They receive the reports from their financial institutions, and it's fed into that country's software system, which is the same as all the other 150, 60 countries use. And through the press of a button, the information moves to the other countries. And if I remember correctly, there was a publication last year, I think, that said that the UK on the 30th of September last year received its inflow of automatic exchange of information almost simultaneously from over 100 countries. This software was coming in any event, but I believe it's been accelerated and its usage has been accelerated through the pandemic.
Yes. Thank you, Peter. Going to Socrates now. Socrates, I mean, you obviously free to comment on technology and how the crisis, the pandemic has brought a shift in how firms approach issues of IT, especially the risk function. But also, if you can, I mean, apart from technology, I would also like to ask you about behavioral sciences, and which is an upcoming area of both academic and professional interest. You have even degrees being offered now on behavioral sciences, postgraduate degrees. So I would like to see your intake also on this, on how behavioral sciences can actually help improve risk-related decision making.
I'll start with the IT. I mean, it's the natural flow, right? So it's all about data and what data, where it is, how much. So for sure, over the past 12 months, AI has come into play, and IT functions are ramping up on using that, because, as Sam said, you can't just walk down the hallway and chat to people. So, people are getting savvy on the actual data we hold globally. You got GDPR, you got Schrems, you got all the legal and compliance issues around, what data and how much. That's one part of it, and I'm sure, from a financial services standpoint, we're leading in that space because we have to, both regulatory and also safeguarding. The only thing we do have is the data, right? So we have to safeguard our customers' data. And behavioral sciences, well, if I speak about insurance companies, I mean, that's my level of expertise. That's been ongoing for I would say, past 5 years. Insurance companies have done their own offshoots. Back in the day when people were suited and booted, the hubs were in jeans and t-shirts, but fun enough, we're all in jeans and t-shirts now, where they were having those sandboxes, closed workshops, working with data, but also working with behavior, human behavior. So it's a combination of that behavioral response from an insured, from what the customer wants, how the customer interacts, coupled with the historic data that an insurance company holds. And you'll find a lot of this, we have found, or the insurance companies have found, a lot of disconnect, because it's been a very traditional way of looking at data, claims, and projecting that into the future without bearing in mind human interaction, consumer buying behavior, trends, the way that the new insurance buyers or the financial savvy people are coming into the market do not think the same way as established buyers. So those are just a few things that I've seen.
Can you mention a practical example of how behavioral sciences may have changed the policy or a product, or taking, of course, a risk perspective, but not limited to that?
Yeah, so again, very simple. For those who drive, they need to have auto insurance. The products have now changed. There's black box technology that subscribes to the behavior of the driver. Obviously, an older person wouldn't really gain much from having that behavioral aspect of Big Brother, but if a younger person would. And that's a new technology that's come into place, and your premiums are linked to the way that you behave. Life insurance, take that for example. You wear a Fitbit or some kind of Apple tracking device. It monitors the way that you, the human person, is actively taking controlling your exposure as a human to obesity, heart rate, all these kind of things, and
whether you exercise or not, for example.
Exactly, and then rewards you appropriately on your insurance premium. So in the past, age, sex, historical background,
medical checkup,
check, and there's a price. So those are two examples.
Yep, that's fascinating. Also, from the compliance perspective, I mean, has behavioral science, has it affected your function as well, Sam? Is it something that bothers you?
I wish it did.
You
I mean,
wish
here's a really good example announced in the UK news yesterday. So it was announced that the
we've lost Sam. Okay, we'll give it a minute until she reconnects. Peter, I mean, with behavioral science, any your perspective on the issue?
I think people in the tax compliance world, I think their behaviour is becoming more compliant as a result of the pandemic, because the tax regulators, I mean, there are a whole lot of regulators in my world, whether it's the tax regulators, whether it's a European Union regulator for DAC 6, whether it's an economic substance regulator, whether it's a trust regulator, whether it's a company's house regulator. There are millions, figuratively, of these regulators, all relevant to tax and accounting professionals. And because those regulators are becoming, the regulator systems are becoming more intelligent, the people who interface with those systems have to be more careful. So my view is that we, the professionals, respect the regulators' systems and procedures more because they're more sophisticated, which means that our behaviour towards them, what we put into those portals, how we phrase it, how we might write something to put somebody on notice as a protective device, that's driving behaviour. That's driving behaviour very much. And on top of, I suppose the most important thing is that with the governments of the world desperate to raise more money, and taxpayers are one of the easiest way for them to raise money, and certainly corporate taxpayers are the easiest way for them to raise money. Corporate taxpayers generally don't vote. Is that the corporate taxpayers generally have to be very, very careful in what they say to a tax authority. It's got to be very clear. It's got to be very concise. It's got to respond to the specific questions. And with the governments wanting more money, that's definitely driving people's responses, how they respond, and when they respond to their timeliness.
Yes, thank you, Peter, for that. Going on with a few questions also that still have here that I want to ask you before I also go to the attendees' questions. One of the issues that troubles risk officials, Socrates, is what does the future actually look like for risk transfer instruments? That's a challenge that is faced by risk officials, professionals.
Yeah, I mean, it depends on the what risk and what category of risk. So some are, nothing has changed, but others, for example, in the there's been sort of a huge uproar regarding the insurance policies of business interruption, and was COVID, was it an insured event? Was it not an insured event? So I think, very high level from an insurance standpoint, I think, legal compliance risk will have a bit more work to do from looking at the contracts of transfer of risk, because COVID has demonstrated that there have been some gaps in the legal interpretation of what is covered, what isn't covered. At the end of the day, insurance is there to indemnify against a specific peril, and it's been there for 300 years, roughly. So, that's one area that I can see. I mean, we can pick up other emerging risks as well. ESG, how do you insure against that, or how do you deal with that? But we can discuss that later on.
Yes, ESG is a very it's an upcoming issue now. But before we proceed, Samantha, Sam, you were about to offer an example with behavioral science, and you said that you wish that compliance functions were more affected, were more by the behavioral sciences, and somewhere there we sort of lost.
Welcome to my world, Adonis. Oh my goodness, never move house without being 100% sure the internet works properly. That's my good common sense advice to everybody. I apologize.
No
But
problem.
yes, compliance is very much a looking back over your shoulder function. You know, everything we design is around what people did in the past, but we're not very good at predicting how people might behave. It's a really good example. It's not directly compliance, but it's also a bit of risk. So I think Socrates, you'll enjoy this as well. So yesterday, the banks in the UK announced they would issue 95% mortgages for first-time home buyers, right? So that's great. They don't have to pay a great big deposit. The same day, a story came out to say that businesses were finding that their level of limits on their credit cards were being cut sometimes up to 90%. So people who may have had like several £1,000s available on their business credit card suddenly had like £250. Now, when the pandemic first started, it was almost impossible to get a home loan. Almost impossible because the banks guessed that people would not pay back these mortgages. And they only waited until we found out what happened. Well, if we knew about people, we would have realized they were all saving money. They weren't going out to restaurants, they weren't buying, they weren't going on vacations. And so they have all this cash. They have been saving up their money so they can pay the deposit on a house. But the truth is, probably these consumers are not going to rush to the banks who refused them 6 months ago because they've had such a terrible experience with it. And the same thing with the businesses. We have no idea now why suddenly they have decided to cut their credit limits. But again, we're thinking, what have we not learned as compliance that we keep making these decisions from fraud or financial crime or even solvency perspective? Did we keep missing these opportunities to actually turn it into something positive? So, you know, I think we would really benefit from some behavioral scientists in our profession.
Yes.
So,
I mean,
can I add something, Simon?
of
That
course,
is amazing.
of course.
It's cyclical. So when I was a first-time buyer 20 years ago, I was getting 105%, and I just couldn't for the life of me understand why they wanted to give me more money. Oh, you can buy furniture and stuff like that. And I was thinking, there's something wrong there. So, you know, we're not far off that 105. I mean, 95 is as close as. So it's we never learn. I mean, that's 20 years ago. So it's quite interesting what you just said. It's a deja vu moment.
Yes.
I'll add something which I find quite fascinating as well. And I got a text message from my bank, and I'm not going to say which bank because I don't want to embarrass them. But they said to me that I was near my overdraft limit, and the overdraft limit on my card, on my bank account, is £500 because I never go into overdraft. But they said if I exceeded that overdraft limit, they would charge me interest at 35%, which I'm thinking, well, that sounds quite usurious. Then I looked at a credit card statement that came in yesterday, and I was fascinated. It said that the interest rate on the credit card was 17%. So I'm thinking, it used to be the other way around. The interest on the credit cards used to be way in excess of the interest on the bank accounts. So suddenly the banks have become very credit averse. Then they don't want to extend any credit, whereas it looks like the credit cards people want to extend credit because they're bringing their interest rates down. So that behavior I do not understand.
It's odd, isn't it? And you think about these 95% mortgages, and then think what a compliance function will typically do, which is they'll ask the lender lots of questions to make sure they can repay back the money. And I'm not sure necessarily that compliance functions appreciate that if these campaigns are successful, they will get large volumes of applicants in, particularly challenger banks. And that is not an exercise you can do overnight. That's not an exercise you can do in 15 minutes to make sure someone is, you know, they're going to have money in the long term to pay that mortgage back. So question whether their compliance functions will be properly staffed to deal with that.
Yes, increased workload with the decision that comes along. Yes. Okay, we have a couple of questions. I'll try to sort of link them with some of the pending questions we have here for today's seminar. I mean, the next question is, how will remote work and the work from home movement affect the company's compliance obligations? We touched a bit on that already. And I would like to add to that something that came on from our participants here. Do you think that supervisors are ready to check the technically complex systems of companies, I assume? Of course, supervisors, we have various supervisors in different jurisdictions, different supervisors. So you might as well answer for the supervisor you feel more comfortable talking about, and instead of overgeneralizing here about supervisors. So Sam, if you want to go first about the challenges from working from home, and oh, there's also one more question that's linked to that. Okay, sorry about that. About the new normal remote working model, and how easy is it for high risk clients to go off the radar in this new normal working model?
Okay, so let's see if I can hit all these three really quickly. I'm going to be controversial and say, as a former regulator, I don't need to have the technical know-how to check your system.
Speaking as a regulator, yes?
Speaking as a regulator, my attitude would be, I don't need to be an IT expert. I do not need to have the same level of knowledge as your engineers, because the problem is with you. If you can't explain to me in plain, simple language how your controls work, and if you can't demonstrate how you know they're effective, then you're not doing your job properly. And people struggle with this. They think somehow the supervisors have to be technologically fantastic, and some of them are, without a doubt. Some of them are very competent. But the issue is, you made the decision to use the technology. It's your responsibility to evidence that it works the way you expected it to. And it's the same thing with working from home. Regulators generally have no problem with people working from home, except if you can't explain how you know people are not breaking through controls, messing documents, putting false information into reviews, people who go offline, you can't find them for hours, you're not sure what they're doing, if they're doing something, they're not downloading stuff into their personal laptops, etc. Those are things a regulator will expect you to have already thought about when you sent those laptops to your staff last March. And if you haven't already thought about those things, you're already on the back foot anyways. So I think those questions, sometimes people need to look at it differently. You're the one who bears the responsibility, not your regulator, so to speak. And as for your high risk customers sort of disappearing and being difficult to follow, look, I worked offshore for 7 years, and I would say the big mistake you make when you work in an international finance center is misunderstanding you are not the compliance function for your high-risk customer. You are the compliance function for your business. If you feel you need to always be in touch with or have visibility over your high-risk customers, they are too high risk for your business, or you don't understand how to do compliance properly. That is not the way to properly supervise your high-risk customers, and I'll leave it at that.
Okay. Peter, if you want to add to that, and then we'll go on to Socrates.
Yes, I'll just focus on one area, and that is the area in which companies can be treated as tax resident in a country other than their country of incorporation, if the company has its central management and control in a different country. And the historical approach to central management and control is broadly where the main people in the company meet to transact the main business of the company, which some jurisdictions still say is where the board members meet, and who the board members are. Now, that's a very important rule, because if the board members aren't able to travel to the country where the company is incorporated and has its main place of business, that gives rise to a question as to whether the company has become tax resident in another jurisdiction. And if it has, then depending upon that other jurisdiction, the company may become taxable on its worldwide income, net income, even though it's only tax resident because one or more board members happen to live somewhere and haven't been able to travel to where they need to be. So that has driven a focus by the tax authorities of the world, and they have become a bit more flexible over the pandemic about where the main drivers are and how the main drivers participate in the main decision making. But, you know, that's a concession by a tax authority. And it's not a concession, I think, that one would really want to rely upon. And the best advised people, or best advised companies with board members stuck in the wrong place, if I should use that expression, was that they would appoint other people to become members of the board during the pandemic who happen to be in the right jurisdiction.
Yes. Okay. Thanks. Thanks, Peter. And Socrates, if you would also like to comment on these issues that they were raised.
Absolutely. So I'm going to sort of put an umbrella over the entire conversation and talk about culture and the tone from the top. So back to Sam's point about, as an ex-regulator, they don't need to see, you know, detailed how everything works. It's the culture of the organization. A regulator picks up the culture and the tone from the top, whether you're this side of the law or straddling the line of the law or on the other side of the law. And that's that. And COVID and the way that things have been for the past year or so has actually been you know, it's taking stock on corporate values and how each organization it has been. So, you know, what might be written as a corporate culture or as a sort of strap line on paper and what actually is may be different. So to the point of, from a risk management standpoint, you know, do we have key risk indicators? Do we have dashboards? Do we have forward-looking metrics? Do we have all these processes in place in order to give comfort to our regulator and our board that all is okay? That's pretty much the sort of umbrella on how you give comfort to others, that you have your own comfort. But, you know, as Sam mentioned earlier, you know, if you're thinking about it right now, you're a year or two too late.
Yes, thank you for that, Socrates. Now, I'm going to take advantage of my position as discussant and raise an issue that I find really interesting. Prior to the pandemic, I mean, one of the key issues that made the headlines more often than not was Brexit. And now because of the pandemic, you know, it has been a bit put on the sidelines, at least the media coverage, you know, it's been undermined in some way, but the effects are still there and no one can ignore them. So what I would like to ask, because this issue of diverging regulatory frameworks is a valid challenge for compliance officers when you have to manage different regulatory frameworks and different regulators operate under different regulators. Now, with Brexit coming in, I mean, is this development, to what extent is it able to contribute to such a trend of diverging regulatory frameworks, you know, having a more complex environment to operate with? And how can compliance professionals better deal with such a development? Sam, if you want to.
Well, I think people working in particular with a base involving European businesses are going to be pulled in two different directions because the divergence is already happening with the UK. So we currently have consultations with our government, HM Treasury, with plans to amend our anti-money laundering regulations in 2 stages. And those amendments are going to take them away from the 5AMLD implementation. They will not have the same wording. Just 2 weeks ago, they have issued clarification around the treatment of high-risk countries, which is different from what's written in the risk factor guidelines in Europe. So it's already happening. You add to that the fact there's been legislation passed about setting up free zones, similar to what you have in Switzerland, right? Low tax areas for antiquities, art, etc. It's already in motion. And the challenge for compliance functions will be, particularly those who are technologically enabled, how are you going to set up these different compliance plans? Are you still going to go with the highest standard across your regions and go with whatever it is they require, regardless of whether the business is based, the customer is based in the UK or not? Or are you actually going to take advantage commercially, if you do have a business in the UK, and have your own ring-fenced UK compliance program where you can benefit from those altered standards? And that's a real Rubik's Cube. It's a complicated puzzle, particularly if you've started automating your monitoring and your screening, because you're going to have different criteria to clear alerts. You will be able to take on some high-risk customers faster, or you might have to look at different aspects of what they do. So it's not a case of if the divergence will happen, it's planned, it's already starting to happen. So now you need to strategize which way you're going to go. Ignore it and keep to the higher standard, or are you going to have your own separate set of rails for the UK?
Yes. Socrates, I assume that this to some extent applies to the risk function as well, different regulatory requirements coming that you need to take into consideration from different jurisdictions.
It does, and again, it depends where you're located, right? So if I speak about operational resilience, which is a big ticket item in the risk space, the UK PRA, FCA have come out and they've said what they had to say. We have a year to do all that, and then you see other, Central Bank of Ireland is behind them. So there's risks and opportunities, I would say. So back to Sam's point, there are sort of those higher level, lower level. Would you capitalize and take some upside, depending on where you're located and who is regulating you? What it does mean, and it is always in my regulatory updates and risk reports, is compliance and risk are now have to ramp up on resource and time and expertise in order to stay on the front foot of everything that's changing, because it's not as it was.
Yes, and Peter, if you want to have,
Yeah.
a broader view on Brexit development, how it could affect your area of expertise.
Yes, I'm just going to focus again on one area, and that and I'm going to talk about mandatory reporting on cross-border transactions. And that's been a big focus of the EU for many years. And in mid-2018, the directive called DAC 6 came in that required companies that had cross-border transactions where the transactions met specific hallmarks to report these transactions to the appropriate tax authority, who would then share them. And there was a very complicated mechanism because more than one person could actually report on the one transaction. And there's no hard and fast rule about whether transactions would meet these hallmarks. Now, the UK signed up to that, and people were reporting to the UK as well as to the other tax authorities within the European Union. And then at the death knell, at the end of last year, the beginning of this year, the UK issued, an HMRC issued a note saying that of the 7 or 8 categories of hallmarks, it was now only going to require people to report on one, which is broadly whether they were entering into arrangements to avoid having to automatically disclose transactions. So almost immediately that the transition period in Brexit finished, the UK diverged from a device that had been set up designed to bring to the surface transactions that companies were entering into that were designed to shift profits. And the UK said, we're only going to ask you to report on what's called hallmark number D, but then we're moving towards adopting the OECD's mandatory reporting disclosure doctrine. So at the moment, the UK is just requiring people to focus on hallmark D, whereas the European Union has got A through about F. And very soon the UK is going to ditch hallmark D from DAC 6 and adopt the OEC mandatory reporting. And I'm not aware of what the rest of what the European Union's approach to that is. But this is a very simple example of the UK divergence almost commencing the day after the transition period ceased.
Yes, thank you for that practical example that illustrates this trend. Now, and again, I'll take my advantage of my position as discussant and raise another issue that I find really interesting, this increasing increased focus that has been placed on green and sustainable finance, issues of ESG becoming more and more an integral part of corporate governance, but also the control functions within companies. And I would like to ask Socrates now, how can risk professionals better adjust to this new trend? And what can be the major challenges related with an approach, the sustainability sort of approach that is gaining more and more momentum?
Yeah, so ESG is definitely on the board agenda, and it's back to that culture of, what does that organization want to look like and feel like, and especially to the outside world, because ESG is everyone's responsibility. But then, if you're in a financial services organization, you have shareholders, stakeholders, and how you portray yourself. So you've got to, from a top-down perspective, identify with how you want to look and feel in the future. So that could be from investments. Do you invest in carbon neutral? Do you ditch tobacco? These are big ticket item conversations for a board level. Do you rebalance the portfolio of your investments? If you are influencing, if you're ensuring, I don't know, coal fired power stations, do you still carry on doing that? Then of course, then it becomes an issue of capacity, because if everyone ditches all that, then again, as an insurer, with 20 plus years experience, who will insure these, fossil, dirty burning, whatever you want to call it? But that's a different conversation. So, it's a governance, risk and compliance, but more importantly, the image of what you, the financial services organization, want to look like, and it starts from the top. But we're always there as a risk and compliance to help them on that journey.
Have the regulators starting giving out incentives in order to ditch these companies, as you say, these dirty inverted commas? Maybe
it's more political than anything else. Yeah, I'd say the regulators are saying that you got to demonstrate how you're approaching this. I don't see any. It's more of a political incentive than anything else.
Okay, that's great. And anyone likes to comment on that, Sam or Peter? I will give you a chance, because I see now that we're running out of time, and I have one last question that tries to sum up everything, and I want to allow you a couple of minutes each to deal with that. Yes, you can possibly touch on that on my last question, which, I mean, given all the challenges that we've discussed, okay, we were talking about the recent financial crisis, we're talking about a huge global financial giants collapsing, near collapse of sovereign states, ongoing pandemic, tensions at the international level between global powers, sanctions coming in the game, shift to green and sustainable finance. Can we predict an evolution or a revolution in the years ahead regarding the GRC field? If you can pause, we have some last questions. That was my concluding question, but let me be fair to our participants and just mention the two last questions we have. With the rise of technology, will technology replace humans? Is less employees needed to do the job? And the other one is, don't you think that it starts from inside? Imagine the outside is greenwashing. And okay, this is about the ESG and greenwashing. Firms sort of pledging that they are actually following green policies, but not in essence doing so. So we need to look at the inside culture, whether it is authentically green. Okay, so I mean, I've bombarded you with a number of questions now, but this is, and you only have 2-3 minutes each to tackle them. But I trust you, and I mean, I spoke so highly of you because you are indeed a competent professional. So let's see in practice, how can you put all these things together in 2-3 minute answers? Sam, starting with you.
Okay, let's start from the bottom and work our way up. Totally agree, greenwashing is a serious issue. A really good example is people who put logos on their websites claiming they're 100% sustainable product using, etc., and then advocate groups find out this in fact is not the case. I think you're always going to have this problem. You want consumer commitments that will pressure businesses to take on a more responsible attitude. But unfortunately, it's easy to put up the curtains and have nothing behind the window of substance. If you check out the Nordics, they do some fantastic stuff around sustainable reporting. They are way ahead of us, but their compliance programs are very, very active in terms of verifying what they report and put out there. So check out some of their websites if you want to see how it's done well. In terms of technology replacing people, seen it happen during the pandemic. Australian company that does insurance had a piece of AI brought in from a reg tech provider to help them with a call center in Asia that had to be shut down because of the pandemic due to the outbreak of COVID. The AI read claims. It did it so fast and so efficiently. It picked up fraud effortlessly. It was really easy to train. And now the Australian company has decided there's no more need for the call center. So the question is, what happens to all those people who had jobs? Right? It's going to happen, and we need to be responsible as a society. How do we reskill people? What are we going to do? Right? Really, really serious question. And revolution, evolution, really quickly. If people think they can evolve going on this journey, they are already sitting back with the turtles. There has to be some quick radical stuff happening here. Like if we don't learn how to twist quickly on our heels to the next unexpected thing or the next positive opportunity, we will be left behind as compliance. And our goal has to be as compliance. We need to be at the table with the big people. We don't want to be left behind as the people they just ask at the end because we are not ready to adjust to change and come up with solutions.
Thank you very much, Sam. Peter?
Yes, again, I want to focus on one, and that is, will people be replaced by technology? I think that is likely in the more standardized functionality of compliance. But when you get to the higher level of compliance, of dealing with tax regulators on interpreting documents and very complex tax laws, I don't see that's possible. I have a current situation representing a client who has put substantial number of documents that support its position to a tax authority. And the tax authority says, well, I don't really care what documents that you put to me and what they say. I don't believe you. And he won't say, or they won't say why they don't believe you, but it's obviously because it doesn't suit the financial objectives of the particular tax authority. So I don't see how that adoption of a different version of the truth can be replaced by technology.
Thanks, Peter. And Socrates, you have the final word.
So we've all embraced change, and we're here. So clearly, we've been agile and adaptive and surviving. But to Peter's point and Sam's point, yeah, some jobs will be lost, the more mundane, routine ones, which can be, AI automated. But I think, the main focus in the future is having the qualified and engaged staff to do the right thing. In our space, no AI or no system will replace the brains and the deep expertise that is on this call and in the functions and the people who represent those functions in order to steer the company in the right way. And we've all looked at perils and risks and as well as opportunities that are over the horizon.
Thank you very much, Socrates. Thank you very much, all of you. This has been a very interesting, insightful discussion. We managed to keep it to an hour duration, which is an achievement on its own. We could have gone talking for hours with these very topical and challenging issues that we've covered. I want to thank our attendees for staying with us. We started around 70 people and we stick with that. No one, quite only a few may have abandoned our discussion earlier. And this points that they were, it was an interesting discussion that managed to keep them on board. Thank you again, everyone. I would like to wish you a pleasant afternoon. We shall see you again soon in our next webinar. You will be notified duly. Thank you again to our participants. Hope the best for you in your future, professional endeavors, and we shall meet again soon. All the best. Have a nice afternoon. Thank you very much.